Subject of today's talk is how to run a system of sale and execution, repossession, foreclosure, whichever you want to call it in different countries, in such a way that properties are only sold as a last resort and not as a first resort in a kind of gung-ho manner. In many countries, virtually all countries, properties are sold which shouldn't be sold. In the sense that it's not necessary to sell them for the bank to retrieve their money or to have a functional mortgage and credit system. One might think or expect that banks would act rationally or in the interests of their clients in this manner, but unfortunately that doesn't seem to be the case, and why that is a subject for another lecture. But certainly in many countries there's a vast amount of human rights violations in the mortgage market. So what's needed is a system of law where banks are required in certain circumstances, or judgments are not given to banks in certain circumstances where it's not necessary for a sale and execution to take place or repossession of the property. There are other options available. Now in South Africa, the Constitutional Court has come out and said they must only be sold as a last resort. That's from JAFTA, paragraph 59. But there's not, the problem in South Africa is there's not really any content to that. What is not a last resort? And so it's been largely ignored by the banks, in my opinion. So what are the other things you can do, and when should a bank not get an order of execution from a judge? When should the judge say, no, you're not getting that order? Because remember that the banks need the participation of the state, which is a democratic entity, in order to get these orders. It's not simply a matter of the bank deciding how it's going to run its business. It needs something from the state, and whether it gets that is a political decision, which should involve the interests of everyone. That's not to say we don't need to support the credit market. We can't be unreasonable, or the banks will decide not to lend. So what do other countries do? What do different countries around the world do that restricts the power of the bank to sell people's houses when it's not a last resort? We have lots of different examples from lots of different countries, and what we need is to worldwide bring them all into one coherent system, which then could be used by all countries with the necessary local changes. So the first thing is, in England and Scotland, but let's talk about the English situation because it's been around for longer. From the 1971, there was a law in England that said if the person now has income to pay the mortgage, pay the bond, then the bank must reschedule the loan and they won't get an order to throw them out and repossess the property. Now there was a long line of cases after that to work out exactly what that meant. It was culminating in one called Cheltenham and Gloucester, which is a building society, like a lending institution in England and Britain as a whole. And what that case basically said is, if with the person's income now, you can reschedule the loan so that he can pay it off over the length of the bond till the end, then that's what has to be done. And if the bank comes to the court and asks for an order, and the person says, well, now I've got income, then if the bank won't reschedule the loan, the court will reschedule the loan for him. But what does rescheduling mean? What it means is this: if you've got a bond at $100,000, let's say, and you've missed a year's worth, or say you've missed $10,000 worth of payments, but now you have a new job, you've got new income, the business has come back, it's established that you can pay the bond, then what they do is you take that 10,000 of arrears and you add it onto the bond. So you've now got 110,000 of arrears, and then you pay that over the length of the loan. So it kind of recognises that people go through crises. It's not necessarily, and usually isn't with houses, that the person doesn't want to pay, is refusing to pay, or has got a lavish lifestyle. We'll come on to that circumstance later on. But in most cases, you can show there was a death in the family. There's been a health event. Somebody's been off work for 2 years with a health problem which is now resolved. If you look at that event, and I think that should be part of the law, where there is such an event, it's a different situation with the person simply being irresponsible. But if you look at that and you say, okay, well, in that case, it's not really the person's fault. So they now have income, let's reschedule the debt in, add on the arrears, and the person now pays a slightly higher amount. So the bank gets all the money in the end, and they pay that off. It's a situation where it's not likely that the person's going to default again. But, it's unlikely that the event is going to happen again. So that's called rescheduling, and it's the norm in England and in some other countries too. So that's the first part of a coherent system. It says if the person now has income, then the loan must be rescheduled. You cannot sell that person's property in execution. That's not to say, sometimes of course you will come to an arrangement where the person wants to sell their property, but you can't force that issue if there's no income. Now in England it goes a little further at times. If you've got somebody that's likely to get a new job, so the example given was you've got a chartered accountant or something in a situation where there's a great shortage of chartered accountants, and for some reason he's been off work for a year. Even if he hasn't got a new job, the court will look at it and say, well, this person's likely now to go and get a new job, and they won't order that repossession order. It's almost like you need an actuarial tables to see what people are likely to get new jobs, what people aren't. If the person's got a very expensive house, then maybe there's less likely that they're going to be able to get another job at the same level. But if they've only got a small bond left, a small mortgage left, then maybe they'll be able to get a bond to cover it. So all these things need to be looked into. But if the person has the income to cover the bond or is likely to get it in the near future, then you shouldn't be repossessing and selling the property, particularly in countries where you can't get a very good price for the property. We talked about that in other lectures too. Second thing you should do is sometimes you just need to wait. Not in all cases. In some cases decisive action is required. But we mentioned in the previous example, if a person's likely to get a job, then the right thing to do is to wait, and no order of repossession should be given. For how long is a matter for regulations, but there's a different situation where you should wait. And that's where the person has a lot of equity in the property. What's equity? Equity is where the house is worth, say, 100,000, but the person's maybe 20 years into that bond or mortgage, say if it's a 25-year-old mortgage, and he's already paid off $80,000 of the 100,000, so he's got 20,000 left. Now, if that person's got any chance of ever having any income in the future, any ability to pay it off, maybe he's got a lump sum coming from his pension in 5 years, whatever the reason, there's much less case to grant that person, grant that bank an order to sell that person's house, because the bank, if that house ultimately, if you leave that for 5 years and the bond by that stage is now 40,000 instead of 20,000, and the bank sells the property for 80,000, they've still got all their money back. So there's much less reason to sell the property there, and it shouldn't be really allowed in that circumstance. Of course, the bank should make the person aware that they're losing the equity in their house and maybe they should sell it, etc. But it shouldn't be able to be forced in the same way. A different scenario is when the person's got a 100,000 Rand bond on a 100,000 Rand house, or even sometimes you get situations in Britain where there's a 105,000 Rand, I'd say £105,000 property on a £100,000 house. So in that case, there's a lot more case for decisive action so that the credit doesn't extend far beyond or up to the price of the house, even when it's close, when it's a £95,000 property and it's and there's say a £90,000 bond. If it's close, then there's much greater case, unless any of the other circumstances are present. Okay, so that's another thing. Sometimes you just wait, particularly in equity situations, and this should all be in regulations or laws that say no order should be given, or rules of court that say no order should be given if these things are present to repossess that person's house. One of the next one is sometimes we talked about people that are maybe older and they have paid off a lot of their loan, or even if they haven't, the bank might not normally lend to somebody that's say 60 on a 20-year loan because they're going to be 80 at the end. But there are solutions for that kind of thing too. And basically what they involve is a situation where the bank will get the house at the end of the situation. So it shouldn't happen automatically. The bank shouldn't be able to do it by right. But if the person says, look, how about I'm 65 years old, I've lost my income, my pension's disappeared, or I don't know, I've not got a pension, I'm now out of work. I defaulted on my bond a few years ago due to illness, so I've still got some outstanding. Let's make an arrangement where you will get the house whenever I die. Or you will get a percentage of the house depending on how long I live. And there's various different ways to do this. It can be an actuarially calculated thing, so on, like a life insurance policy where the bank basically bids, different banks bid that they'll give different, maybe, and sometimes the person will have to pay something, maybe they're paying, let's say, $1,000 in their bond, and now they can't afford to do that, but they can't afford to pay $300, so they pay $300 and the bank gets 50% of the house at the end. So there's all kinds of range of deals, but situations like that should be in place and should be allowed before a bank gets an order to execute against that property if it's at all feasible actuarially that kind of situation could take place. In situations where it's not feasible, then you could even have a situation where the person gets to stay there for 10 years and then the bank sells the house, but that's a lot more dodgy because then you've got an old person being thrown out at the age of 70 or something. So the lifetime deals are best. Obviously this means disinheriting the children, but if that's that person's choice, then that's what their choice must be. Then there's situations where you can develop the property. So I'm thinking of situations where you've got kind of old, bigger houses. In South Africa, there's places like Bryanston, where a person's got a house, it might be a bit run down, they've been staying in it for 40 years, let's say, and they've not got much money, but it's got a large part of land. Now, meanwhile, the city is densified around them, so there's lots of flats going up. And so, in actual fact, you can bring a developer in and they can develop half the property or 3/4 of the property that was just grounds, and that person still gets to stay in their house. Now, that involves a situation where you have a national system, or each bank has their own system, where they say, here's a property with development potential, let's put it out to the developers, and if somebody comes along within 2 or 3 months and says, okay, we're willing to do it, and the person says, yep, I want to stay in my house, I don't mind if you build flats in my garden, effectively, rather let me stay here, then that could happen. So it's just enabling a system there. And again, if the bank goes to try and get an order to shut that person out and they haven't, and it's got development potential and they haven't put it to a network of developers, then again, they shouldn't get an order, and that should be the law. So there should be, after a while, a system would develop where the bank could say, look, we've gone out to developers, nobody wants to develop this property for whatever reason, and then they get their order if nothing else is present. Also, sometimes you can subdivide a house. You can take a 2-story house and make it into two flats. Again, that has to be looked at. It's not a last resort if you haven't looked. That's not feasible in most situations, but there might be a certain number where it is feasible. Also, securitization. Securitization is when you actually sell the bond, the mortgage itself. So you don't sell the house, you sell the mortgage. That could be in a situation where the bank's got a different appetite for risk than some of the investment public. So this is quite funny because we're always, in some ways, securitization has been a bad thing, mostly because of the way it's done. It's done in a very secretive way, sometimes without proper process, but that's not how it's always done. When I got my mortgage here with South African Home Loans, you go to see them and say, okay, where do I sign the documents? And I said to the lady, well, who's this other company here? And she told me quite openly, oh, we sell these loans, we don't keep them on our books, and that's the company that's buying them. Now, if it's done in that way, in an open and transparent way, and I agree to it, I'm not saying in law I have to agree to it. It can be done, a session can be done without agreement, but if it's better if it's done with the agreement of all the parties involved. And securitization can actually be a good thing, and I'll tell you why or when. So the person's defaulted on their bond, maybe it's a financial crisis. The banks have to comply with their Basel requirements for what percentage of defaulting loans they can have, so they've got to get them off their books. One way is to sell the person's property, which can be very unjust. Another way is to just simply sell the loans, and other people that are not banks buy them up and hold them until the situation recovers. Now, they would have to obviously get them at a discount of some kind because they are defaulting loans, but the bank can sweeten the deal by putting in good bonds, so there's good bonds and bad bonds. They've got to know what they are, not like the financial crisis where they sold all kinds of loans and didn't tell people what kind of loans they were, or not the full story anyway. So it's all going to be done in a non-fraudulent way, obviously. But that's another thing. Has the banks taken these defaulting loans and tried to sell them to the market? And if they haven't, then they shouldn't get any orders until they have that kind of system in place. They'll say, of course, that people only want to buy good loans, and that's the way it's done, and it kind of is. But there are ways to make it work. At a certain price, all loans are a good deal, and so it's going to cost the bank something to go through the sale and execution process and repossession. So maybe they must make it, there's got to be some kind of regulation or understanding about how, in what circumstances they're allowed to do different types of securitization. There are some very obvious times when banks shouldn't get an order to sell. In South Africa, where there's an offer to purchase pending, I've still seen, with the bond in place or a cash offer, I've still seen the banks sending a house to an auction and selling it for far less than the amount offered. Obviously, that should be not allowed. If the judge should say, or the bank should have to aver in their papers that there's no offers to purchase pending, or that there is, and this is the amount, so that the judge can set a reserve price. So there's obvious situations like that where when somebody's offered to pay the arrears on the loan, or when the arrears have already been paid. These are obvious situations where it shouldn't be allowed to sell a person's property. It's obviously not a last resort in that circumstance. But yet here in South Africa they do get sold in these circumstances. So another solution is mortgage to rental. There is a subset of consumers where the actual house is very important. So for some persons, they've been in the house for 2 or 3 years. They don't particularly love it. It's a financial asset. They want to get out with as much money as they can, or losing as little as they can, but they're not really attached to the house. Other people have got a huge attachment to the house, and there's a whole literature called home interest in the academic literature, which talks about the psychological and philosophical and architectural literature talks about this connection you can develop to your home. So for example, if you grew up in the house, if you've been there for decades, if your children grew up there, if you built the house yourself, and various other ways, if you did a lot to it, if you developed it the inside, if you decorated it, etc., if it's got lots of happy memories for you perhaps, then a house is much more than a house, it's a home, and it can have huge psychological value to you. Now in that situation you might think to yourself, okay, look, I know I can't afford the rest of this mortgage, but I want to stay in this home. Now for these people, we should respect that right where we can, or that there's more to a house than just being a financial asset. Then in some circumstances, we can convert the mortgage to the rental. So the bank effectively must be required to have a rental agency. That doesn't have to be the bank's own one. It can be in-house, it can be external. In some cases, it's the state. And you sell the mortgage or transfer the mortgage with the person's consent, with the debtor's consent, to a new entity that then rents it back to them. So that would be in situations where, and this varies from country to country, where the mortgage they're paying is far more than the rent would be, the market rent for that circumstance. So that can be an option in some circumstances where the person really wants to stay in the house. And I've met many people in this in this situation where they say no, at all costs they want to stay in, even if they have to pay rent to a new landlord or whatever. So before the bank, if the bank hasn't got a system, obviously you can give them some time to set these things up, but if the bank doesn't have a system that says, okay, here is a situation, sent it out to maybe, well, I don't know if it would be a few big ones or many little ones or a combination. What price will you offer to buy this mortgage, and the person will pay you X rent for the next however long. It would obviously need to be protected from people that buy it up and then chuck the person out very quickly. So you're trying to develop a situation where it solves the interests of all parties, and where the person can actually afford the rent going forward, even if they couldn't have afforded the mortgage bond. So that's another option that should be looked at before before a house is sold in execution and the person evicted. The other thing, of course, is in the sale and execution, you can say this house is being sold with a sitting tenant. That would be another way to do it. So you're buying the house with an existing lease on the condition that you continue to rent to this person. It's a very similar thing, just a different legal way of doing it. Another way is when the person's income is dropped, but it's dropped to a level where he can afford a lower house. So he cannot afford the house he's in, but the bank is required to offer him a bond at that lower level. So say somebody's at a health event or he's lost his job or something. It's something that's not his fault, but he can afford a lower bond. Perhaps in circumstances like this, it should be required of the bank to offer him to continue with his bond, but at a lower level with a lower house. So he has to move house from one high house to a low house, but the bank, before they get an order to sell the house that he's in, or work with him to sell with his consent, they're required to actually offer him a bond at the lower level. Now that obviously is not suitable when you've got a person who's intentionally defaulting, but when you've got a person who they've done nothing wrong, they've just lost their job, why should they, some people ask, be put out in a situation where they've now got a judgment against them? They can't really even easily rent, they certainly can't bond again when they're not in fact at fault. Credit rating should be for people that intentionally default, ideally, not for people that have, through no circumstances of their own, had to default. So sometimes it's difficult to determine between these two things, particularly with unsecured debt where there's not a lot of debt. But in situations like mortgages where there's a court case about it, then if you like, the integrity or the moral standing of the person can be determined, and in that situation perhaps it's reasonable to require the person to, before granting an order, to ensure that the bank has offered the man or couple or whatever it is a mortgage on a lower house that he can now afford with that income, rather than throwing him out into a situation where he can't get a bond anywhere and has to put down 4 months deposit in order to rent. And then any other situation that I haven't covered, and maybe some I've forgotten, where it's not a last resort. If it's selling a person's property in execution, repossessing a house from somebody, should not be an easy thing to do. It's a violation of people's rights, and it doesn't really, not being able to do it so easily doesn't really affect the rights of the bank. They're able to do it in the circumstances where it is necessary, but it's a small percentage of mortgage loans. Oh, I'll tell you the very important one that I've missed out. The few people who are actually intentionally defaulting on their loans. So they've got the ability to pay, but they've just decided not to pay. They've decided they're going to have a more lavish lifestyle, they're going to live it up. Now in these circumstances, what you can do is attach the person's income. So it's called different things in different countries: emolument attachment orders, garnishee orders, income attachment. But the person can afford to pay, so the courts finds that out, and it tells the person's employer or the person's credit debtors or whatever, you'll pay this to the bank directly. rather than it being paid. So there are people that do that kind of thing, and you might think if we had a system like this, then there might be more that would default because they would then say they would take advantage of maybe a more lenient system. Well, no. When people are intentionally defaulting, when they have the ability to pay, you should be able to tax their income, and in that kind of circumstance. And again, attaching when you can attach somebody's income, when they have the ability to pay, then there shouldn't be any repossessions or sales and execution because there's a less restrictive means. It's not a last resort. You can do something else that's less radical. So that's the final one. So just to give you an overview of this, why is this necessary for a properly functioning mortgage market? Because from a political point of view, to the government of a country, if you've got thousands of people, millions of people being chucked out of their homes when it's not necessary, that's a political issue. That's going to cause discontent. And everybody then who's got a home is scared of being chucked out of their homes. But if you've got a rational system where people are only removed from their homes as a last resort when you can't do anything else, that France requires the bank to sit down with the person and actually discuss it and work it out, and before they've done that, they can't get an order to remove the person from its home. And that's probably a good idea as well. But yeah, so it's actually better for the banks. I don't know why the banks are so gung-ho. It's partly because they have to, they're worried about their ratios, that they've got to comply with regulatory. So that another type of regulation that tries to keep banks solvent is actually interfering with this type of regulation, which is trying to keep banks protecting the consumer from banks, I suppose. But as I say, you can use securitization to deal with that issue. So you can do all these things, and the banks are still able, when there's absolutely nothing else you can do, to get their money back in these circumstances. But many of these solutions will actually give the bank their money back. So if the bank talks to the person and they say, look, I'm going to have income soon, and the person doesn't have income, and then eventually they've got income, and reschedule the loan, well, the bank's in a good position. They're back where they started. They've got income coming in. They're making money. So many of these things, it's enlightened. It's actually helping the bank in a way to be. It's not running its costs up. It could actually be a new way of doing things for the bank that's actually better. But certainly there should be laws in place to protect the consumer, to make sure that every one of these solutions and any other reasonable solutions that can be devised are tried before a person's house is sold in execution. Thank you.